Brenda, I was looking at it. It looks like a Ben Franklin close, and I counted up the reasons to own the market versus the risks, and I think it's like 8-2 or something in your view. Have I got that about right? What are the reasons to own it right now?
That's right. I think we have to look at kind of the big picture and look at what's happened over the last several months. And we had an environment where vaccine rollout got off to a shaky start, and now the U.S. is a leader globally in vaccine distribution. We also have an environment where the U.S. is also a leader in terms of overall stimulus. And we've seen it coming through in terms of economic data, where we just had a recent string of very strong ISM numbers, both on the manufacturing and services side, that were at or near all-time highs. We also got confirmation that the employment market is starting to broaden with a really nice pickup that we saw in the leisure and hospitality industry. So by many measures, things are looking brighter. So I think this, and against the backdrop, I'll say, of an environment where we did see long-term interest rates step up pretty meaningfully earlier in the year, but things have stabilized over the last month. So I think when we look at reasons to own the equity market, it's because of the brighter outlook that we see going forward. And secondly, because when we look at bonds, stocks are still an attractive place to be relative to bonds. For those who are really looking to earn a return in excess of inflation, it still makes sense in our view, to have exposure to the equity market. And we could also argue, too, that if we look at forward earnings projections, while we're certainly expected to see some really nice growth year over year, you could also argue that we're really not expecting to see a significant pickup in the second half of the year, to the tune that we could really see it transpire. So I think those are all reasons to be positive, although I think, at the same time, we have to be cognizant of the fact that there is good news baked into the market here. So staying disciplined is certainly an important part of our view. And by that, I mean, scaling back some equity exposure when it makes sense. But really, broadly, we continue to be very comfortable being overweight equity for our clients.
The two risks you highlight, we still don't know, and it's been on everybody's list for the past year, and that is the path that COVID takes, and there's variants, and there's, even though the vaccine rollout's going much better, that was one of your positives, but there's still a question mark there. And even though bonds are attractive, or stocks are attractive versus bonds, inflation is a potential issue, you think, down the road, maybe.
Absolutely. I think it's something to monitor. I mean, we have never been through an environment where there's been this much stimulus. So I think there is an argument to be made for why inflation could absolutely begin to increase. And, aside from potential COVID risks that nobody really knows, if we were to see a strain develop that garnered the current vaccines, not effective. But outside of that, what really keeps me up at night sometimes is thinking about what would happen if we did have an environment where interest rates started to rise pretty significantly, and inflation was out of control.
Shepard Smith here. Thanks for watching CNBC on YouTube.